Greetings, welcome to Q&A with Dharmo. Singapore and the world recently are facing low interest rate environment. Many people are concerned about finding higher yields nowadays. I am Priscilla Koo from UOB Asset Management, Digital Channel and Sales Team, and I'll be interviewing Dharmo Soejanto, Chief Investment Strategist for UOBAM Invest, to better understand this dilemma. Dharmo, do paint us a picture of the current market condition.
Well, Priscilla, what we're looking at is likely the worst recession we have seen since the Great Depression in the 1930s. The US economy shrank almost 33% annualized in the second quarter of this year, and unemployment rate peaked at 14.7% in April. Even with the unlocking of the economy, the US unemployment rate remained above 10% in July. We see a similar picture in most economies around the world. That is, a sharp contraction during the COVID-19 lockdown, and then a modest recovery that resulted in economic output still substantially below the pre-pandemic level. With government subsidies for businesses and personal income gradually wearing off, we expect a slow recovery from here until a vaccine can be found. Many businesses may not be able to survive with the economy operating at suboptimal capacity. This means that central banks around the world will likely keep interest rates low for much longer to stimulate growth. The low interest rate environment has been a challenge for many savers and conservative investors. Where 10-year Singapore government bond used to pay 2% interest at the beginning of 2019, it is now only yielding about 0.8%. With 1-year FDs around that level, many savers and investors struggle to find sufficient return.
I see. If so, what will be UOBAM's suggestion to investors, especially for those who are conservative, looking for yield? Also, what will be the considerations to strike a balance between yield and risk?
Our suggestion is that investors could venture into money market funds and short duration bond funds. These offer expected returns of 1.2% and 2.5% respectively, with slightly higher volatility. These are fairly safe investments with very low default rates. The short duration also means investors are not exposed to interest rate risk. If investors have a longer investment horizon, then high-grade bond funds may be a good alternative. This would require active credit analysis to ensure that one avoids companies that may be downgraded or default. Investors need to understand that higher yield will come with higher risk, especially in the current low yield environment. There are, however, ways to mitigate them. One is through more active credit analysis to avoid the blowups. The other is through diversification to find different sources of income to reduce volatility.
Thank you, Dharmo, for your insightful perspective. Stay tuned for more Q&A with Dharmo. See you next time.